Welcome back. This video covers the lecture for Chapter 15 of the Intermediate Accounting Volume 2 textbook. We are talking about shareholders' equity. Our learning objectives are as listed here. We're looking at the corporate form of the organization, in particular, the rights of shareholders who own shares in the corporation, and different types of shares and their impacts and disclosure issues. We'll talk about issuing shares, reacquiring them, retiring them. We'll talk about stock splits and dividend distributions, both stock dividends and cash dividend distributions. We'll talk about the components of shareholders' equity and how they're presented in a balance sheet. We'll talk about disclosure requirements for note disclosure, and we'll talk about key ratios related to equity. So things like market to book value and price earnings, those sorts of things. We'll talk about major differences between ASPE and IFRS and what standards are being examined for changes or introduction in the future. There are a couple of appendices for this chapter. One talks about par value and treasury shares. Par value shares are those who have or which have a stated par value, and the accounting for them is slightly different. The CBCA, the Canada Business Corporations Act, doesn't issue par value shares any longer. They used to, but they don't anymore. So it's not really an issue for most Canadian corporations. Some provincial Business Corporations Acts still allow for the possibility of par values, and in the U.S. they're more common than they are in Canada. So they could be an issue, but they're not a central issue for our consideration in this course. So if you're interested, take a look there. Treasury shares are covered in the same appendix, and so treasury shares are shares which the firm has repurchased with the intent to reissue them as opposed to canceling them and removing them from outstanding status. Appendix 15B talks about financial reorganizations and how we would account for that in the case of a financial reorganization which is acceptable under ASPE, Accounting Standards for Private Enterprises. Once again, it's not something that we're going to be covering in the course, but the text is there and available for you to read. So let's begin. There are a few different forms of business organization. Proprietorships and partnerships are not distinguished from the owner of the business. So in those cases, the earnings of the proprietorship or the partnership are taxed in the hands of the individual because they're not legally separate from the individual. That, however, is not true for a corporation. The Latin root for the word corporation is corpus, which refers to a body, and it actually refers to the fact that we've created a distinct legal person with a number of legal rights and responsibilities that are very similar to your rights and responsibilities as individuals. So, for example, corporations can sue and be sued. They can be held liable for liabilities. So the owners of the corporation are different legal entities from the corporation itself. So whereas the corporation could be held liable for corporate liabilities, the investors have a maximum amount of liability. The maximum amount of liability is what they've actually contributed to contributed to the corporation in their investment. Corporations have an unlimited life because their life doesn't depend on the life of the owners, whereas proprietorships and partnerships, if one of the owners passes away, they're no longer the same proprietorship or partnership. They cease to have legal existence. Corporations have the ability to hire managers to pursue capital. They can, in general, raise more capital than individuals can because they can sell additional shares. They can be transferred between owners much more easily than proprietorships and partnerships can be because of the fact that the ownership is attached to the shares rather than to the existence of a human individual person. So, some things to think about with regard to different forms of business organization. So Chapter 15 focuses on the shareholders' equity section of the corporate form of business organization. Shareholders' equity represents the amount that was contributed by the shareholders and the portion that was earned and retained by the enterprise as opposed to paid out as dividends. There's a definite distinction between liabilities and equity that must be understood if you're to effectively grasp the accounting treatment for equity issues. So this chapter addresses the accounting issues related primarily to capital contributed by owners of a business organization. So the Canada Business Corporations Act and most provincial Business Corporations Act allow for shares without par value. They do not allow for shares with par value. So the Appendix 15A coverage is going to be excluded from this course, or from our treatment of this course. So if you would like to know more about that, Appendix 15A is provided to cover the basic aspects of accounting for par value shares that are permitted in some Canadian jurisdictions and the U.S. and many other countries. The basic idea is that there's a number called a par value, which is associated with each share, and so the par value shares have two components. When you buy a share which has a par value from the firm, you pay for the par value, and that par value is separated from any contributed capital. So a contributed surplus above the par value would be treated in a separate account. But take a look at it, Appendix 15A, if you're interested. So in a corporate form of business, the shareholders are said to possess a residual interest in the business. So that means that they bear the risks and rewards of ownership, and so they pay off all of their required liabilities. Then whatever is left over in terms of the value of the business belongs to them. So it's residue or residual ownership. If the business is profitable, the owners benefit because their share prices go up, or they receive dividends. So there are a couple of ways of receiving returns on your investment. If a business isn't profitable, the owners are the ones that stand to lose their investment in the business first. So the shareholders' interest in a business enterprise is measured by the difference between assets and liabilities. Remember the old accounting equation. The accounting equation says that assets is equal to liabilities plus equity. It's recorded in the shareholders' equity section of the statement of financial position. Shareholders' equity is not a claim to specific assets, but a claim against the portion of all of the assets as a whole. So there's two primary sources from which shareholders' equity is derived. One is contributed capital, contributed by the shareholders, also called paid-in capital. And then there's income, which are earnings, and the earnings which are retained by the corporation are included in shareholders' equity. So income increases retained earnings, dividends reduce retained earnings. Contributed capital is the amount that was advanced by the shareholders to the corporation for use in the business. Is the price originally paid for the shares. It's only that initial transaction where cash is paid for the shares and the cash goes to the corporation itself. Subsequent transactions on what we call the secondary market, the first transaction where the firm issues the shares and receives the funds for it is called the primary market. The secondary market is transactions between the subsequent purchasers of the shares and other investors. So the profits or the cash paid for those shares after the initial public offering would be exchanged between shareholders. So earned capital. Earned capital is the term that we use for the capital that develops if the business operates profitably, so retained earnings, and also accumulated other comprehensive income. Other comprehensive income being in general unrealized changes in value of the firm's assets and liabilities. Relevant sections of the accounting standards are listed here. This is in addition to the PowerPoints from the publisher. So the shareholders' equity is addressed in a number of sections of ASPE. They're the ones that are listed as sections, and the IAS and IFRS standards refer to the International Financial Reporting Standards. So if you want to find out more information about the actual standards that bear on this chapter's subject matter, take a look at those areas. In Canada, a business organization may incorporate either federally or provincially, and by submitting the necessary documents to the appropriate government office. And federally incorporated companies are created and operate under the provisions of the CBCA, the Canada Business Corporations Act. So, in order to create and operate a corporation, you have to submit articles of incorporation to the corporation's directory of Industry Canada. So articles of corporations, and the corporation's directorate of Industry Canada will issue a certificate of incorporation after ensuring that everything is in order. So once the certificate of incorporation is issued, the corporation is recognized as a separate legal entity bound by the laws of the country and the provisions of the Act, the CBCA, the Canada Business Corporations Act. The entity's owners have greater legal protection against lawsuits because there is limited liability to pursue them for the debts of the corporation. An added advantage is that the incorporation involves the issue of shares, which allows access to capital markets and allows ease of transfer between owners. Corporations may be classified by the nature of ownership. There are public sector corporations, so government units such as municipalities or cities, government business enterprises such as Canada Post, commonly called Crown corporations in Canada, and private sector corporations. Private sector corporations include non-profit entities as well as for-profit companies. Only for-profit companies issue shares. Non-profit organizations issue memberships or have some way of allowing the public to participate in the objectives of the non-profit organization. But in this course, we're going to be talking about public for-profit companies and their shares. So those shares are available to the public. Generally, they are traded on a stock exchange. They can be if the firm is large enough. Not all public company shares are traded on a stock exchange, but public companies are required to follow IFRS, which is now the standard for public companies to follow in the CPA Canada Handbook. Provincially incorporated companies would be subject to the requirements and provisions of the respective province's Business Corporations Act. And the relevant pieces of information that are attached to the firm's charter or the firm's articles of incorporation, the certificate of incorporation or corporate charter, would include the company name, the location of the registered office. So if you wanted to sue them, you would have to do that. That's usually the lawyer's office. Any classes, different classes of shares, and their authorized number of shares. So the authorized number of shares is the maximum they could issue. The actual issued number of shares are the ones which are currently outstanding. Any restrictions on the transfer of shares between owners, the information about the directors, the current directors, the number of directors who are allowed, the method of electing them, those sorts of things. Restrictions on allowable areas of operation for the business would be included as well. So within a given class of shares, each share is exactly equal to every other share, so every single share has the same rights as every other share in that class. A person's percentage of ownership in the corporation is determined by the number of shares in relation to the total number of shares which are owned by all shareholders of that class. So unless there are restrictive provisions for participation of one class as compared to another, each share would carry the right to participate proportionately in profits and losses, in the right to vote for directors, the right to participate in the value of corporate assets upon liquidation. So in addition to these three rights, the CBCA allows a corporation to assign a preemptive right to any or all classes of shares through an appropriate specification in the Articles of Corporation. Preemptive right gives the shareholders of that class the right to have the first opportunity to purchase their proportionate share of the shares in that class in case of new shares being issued. So this can be accomplished a number of ways. It can be a cash call for purchases of new shares, or it could be a rights offering where in order to buy new shares of that class, you would need a certain number of rights, and those rights are only available through the ownership of existing shares before the issuance of the new shares. Transfer of ownership between individuals in a corporation is essentially accomplished by the existing shareholder selling the interest in the company to another individual, and the only requirement in terms of the corporation involved is that it needs to be made aware of the name of the individual, because they need to keep a register of the shareholders. So a subsidiary ledger of shareholders is maintained by the corporation or its registrar and transfer agent, which is often the lawyer, for the purpose of dividend payments, for the issuance of new stock rights, voting proxies, so giving someone else the right to vote your shares. That needs to be registered with the corporate registry. Common shares represent the residual interest in the company. They bear the ultimate risk of loss, and so they basically get everything after everybody else is paid out. Common shares are guaranteed neither dividends nor assets upon dissolution of the corporation. They're the last ones, so they may not get anything if there's nothing left over after everyone else is paid out. In general, though, common shareholders control the management of the corporation through the election of the boards of directors. They tend to profit most if the company is successful. They get the residual amount of profits. And in the event that the corporation only has one authorized issue of shares, that issue is by definition common shares, whether or not it actually calls them common shares in the corporate charter. The amount that an individual pays for shares in a corporation represents the maximum amount that individual can lose in the event of corporate liquidation. That's the concept of limited liability, and we'll be talking about that. Sorry, I'm not keeping up on my PowerPoints here. So, common shares represent the basic ownership interest, and they're not guaranteed to get any dividends or any assets on dissolution. The common shares, the main advantage of the common shares is to control the board of directors by way of voting. Preferred shares come in a number of flavors, and so both preferred and common shares receive dividends. The profits of the corporation are distributed to shareholders, and those distributions are referred to as dividends. In general, dividends can only be paid if the company's capital will be maintained intact, so you can't actually pay dividends out of the capital. Dividends also have to be formally approved or declared by the board of directors before it's a liability of the firm, and the dividends have to be maintained in full agreement with all of the share capital contracts and the charter of incorporation, all those sorts of things. If we issue special classes of shares with preferential rights, they're often or usually called preferred shares. And a common type of preference is they have a prior claim on earnings and a prior claim on assets upon dissolution. Preferred shares can be cumulative, convertible, callable, redeemable, retractable, and or participating. So the list at the bottom of the slide here includes all of those items. So let's spend a moment to talk about what all of them mean. Cumulative means that dividends in arrears must be paid before any profits can be distributed to common shareholders. So if we don't pay the preferred shares their dividend this year, then next year we have to pay them sort of last year's dividends plus this year's dividends before we can pay the common shareholders any dividends. Convertible means that preferred shareholders may, at their option, exchange the preferred shares for ordinary shares on the basis of a predetermined ratio. They could be convertible into other securities, but in general, when you see the word convertible, it refers to conversion to common shares. Callable or redeemable means that the company can actually buy them back at a specified future date and at a stipulated price. Retractable means that the holders can actually sell their shares back to the company under certain terms. So callable is an option held by the corporation to buy back the preferred shares at a specified price. Retractable is an option held by the owners or the holders of the shares, and they can sell their shares back to the company with a specific exercise price. And so the shares have a mandatory redemption period or redemption feature that the issuer can't control, so that the holders can sell their shares back to the company within that redemption period. Participating shares, they can actually participate with common shareholders in profit distributions. Usually that's established if the profit distributions are higher than a certain prescribed rate of payment. So That participation involves a prorated distribution based on the total par value of the outstanding preference and ordinary shares. So there's a value that's attached to each common share and each preferred share, and that value is used to determine the distribution of profits above a certain level. Preferred shares are often issued instead of debt to keep the company's debt-to-equity ratio within a certain range. So if you're close to violating some debt covenant with the debt-to-equity ratio, you can issue preferred shares instead. But you can see that these terms might make the preferred shares look very much like a bond or an equity issue. If it's cumulative, that means that no money can be paid out to the common shareholders until the dividends in arrears are paid to the preferred shares. And if they're callable and retractable, those terms apply to bonds as well. Convertibility is common for bond issues as well. And some bonds are even allowed to participate in income. So income bonds also kind of make the delineation or the line between preferred shares and debt somewhat difficult to see. So kind of fuzzy. Limited liability. The idea of limited liability means that because the corporation is a separate legal entity from the corporation itself, the shareholders cannot be held liable for the actions of the corporation. And so unlike the partnership or proprietorships, their assets are not attachable by the creditors of the corporation. So generally, the shareholders are not liable for the obligations of the corporation. If they're involved with illegal acts, then the corporate veil, they can look through the corporate veil if there are illegal acts being done by the corporation, because corporations don't actually have a conscience. They don't get to choose whether their members, employees, management do good or bad things. So that's actually the individual who's making the decision to involve themselves in illegal activities. So it is that the corporate veil does not protect you in the case of the corporation doing illegal stuff. And if you're the one doing it, you can be held liable. I guess that makes sense, doesn't it? Shareholder losses are restricted to the amount invested in the corporate shares. The worst the company can do is go bankrupt, in which case you lose all the money that you invested, but you're not required to put more money in later. Profit distribution, the idea of the payment of dividends. There are restrictions on how much can be paid out, and the applicable laws of incorporation normally provide information concerning legal restrictions related to the payment of dividends. So the CBCA prohibits the declaration or payment of dividends if such an action would render the corporation insolvent. At any rate, the corporations rarely pay dividends in an amount equal to the legal limit. This is in part due to the fact that the assets represented by undistributed earnings are invested in a variety of operating assets, and therefore they're used to finance future operations of the business, and they're intended to contribute to the going concern of the business, as opposed to being distributable as liquid assets. So while the unencumbered credit balance and retained earnings is normally considered to provide the basis for dividend distributions, very few companies pay dividends in amounts equal to the legally available amount. So the major reasons include either agreements with creditors, so they aren't allowed to pay below a certain amount of retained earnings, the need to finance growth and expansion for the business. They need to be able to retain or plow back earnings into the corporation. The need to provide for continuous dividends in both good and bad years. So reducing your dividend payout is a substantially bad signal and results in share price reductions by the market. And they may feel that there's a need to keep a cushion beyond what was originally contributed to the business. So there's a number of reasons that companies don't pay out all of their available retained earnings to the shareholders. If there are no funds available for the payment of dividends, then the the fact that there's a credit balance in retained earnings doesn't really mean anything for the payment of dividends because they don't have the funds to actually do that. So management has to ask two questions before declaring a dividend. One is it legally permissible to do that? And is the paying out of company assets an economically sound decision? So, how do we account for the issuance of shares? Well, the basic idea is what's shown here. Under the CBCA, shares must be without a nominal par value. So, this means that all the proceeds of the issuance of shares must be credited to the share capital account, as opposed to two categories. Par value establishes a nominal value per share, and that's the minimum amount that must be paid in by each shareholder. Any additional contribution above that is called contributed surplus. Check out Appendix 15A for the coverage of this issue. When no par shares are issued, the share capital account, as we see here, is credited for an amount equal to the value of the consideration received, which is usually cash. Now, shares can be sold on a subscription basis, and on a subscription basis, the full price is not received initially. They receive some payment, and then there's a partial payment that's made originally. The shares are not issued, and rights are associated with them are not actually received until the issuing company receives the full subscription price. So you basically are making installment. You're buying the shares on an installment purchase plan. When an individual subscribes to a common share issue, the corporation debits subscriptions receivable and credits common shares subscribed. And so they account for the common shares existence, but they also set up the receivable from the shareholder as a subscriptions amount. If there's more than one class of shares is sometimes issued for a single payment or a lump sum amount, so you can buy shares of more than one class at a time. Such a transaction requires us to allocate the proceeds between the classes of securities. So one way is to use the relative fair value method, another way is to use the residual value method. So this is in the case where you're issuing more than one class of shares for a single payment or a single lump sum amount that covers the value of both classes of shares. The relative fair value method is used when the fair value of each class of security is readily determinable. So whatever the fair value is on the market for the shares, whatever the percentage is of market value is associated to the proceeds by the same proportions. The residual value method basically says we've got a good value for one of them, and the rest of the value would be a residual value or leftover. So if no fair value is determinable for any of the classes of shares, the allocation may have to be basically an arbitrary decision specified by the terms of the transaction. Shares which are issued for consideration other than for cash. We're not moving along here. Okay, so let's deal with this slide first. If we sold 500 common shares for $10 each, the cash goes up. The share capital account goes down. And if shares are sold on a prescription or subscription basis, it's basically installment payments. Dividends may be attached to subscription shares once the initial payment is received, but shares are not issued, and no voting rights or dividends are paid until the full subscription price is received. So in the case where dividends are declared on subscription shares, they may be held in trust until the shares are actually paid. So the accounts that you need to follow for share subscription, you need to set up an account called common share subscribed, so that the common shares which are actually issued and outstanding are treated separately from the common shares which are not yet purchased and do not have voting rights. That's important information, so it's relevant. So you would set up a separate class for common share subscribed for each type of share. It would be an equity account, would be reported below the respective share capital account to separate them and their rights from the fully participating common shares. Subscription receivable would be normally a current asset, so it's a receivable from the shareholders. It may be reported as a contra account to the shares subscribed account in the equity section. So the net amount outstanding for shares that are subscribed but not fully paid for might be shown as a net balance in the shareholders equity section. Share capital is credited only when you've actually paid for everything, or it could be settled in some other manner, in which case you receive a partial issue of the common shares or something like that in the case of default on those shares. So it's not actually part of share capital until the shares, the subscribed shares, are exchanged for actual common shares issued and outstanding. So for example, 500 common shares are sold on a subscription for $20 each. 50% is due as the initial payment. The other 50% presumably is due later. So the initial entries we would set up would be debit subscriptions receivable for $10,000, 500 times 20, the whole amount, and common shares subscribed would be $10,000. And so if we received one payment of $5,000, we would set up, we'd record the cash coming in at $5,000 and record a credit to subscription receivable to bring it down to $5,000. So now they owe us $5,000. There's common shares subscribed of $10,000 and we have cash of $5,000. So if all the payments are then made as scheduled, cash would go up by $5,000, subscription receivable would be completely received, and so then you would exchange the common shares subscribed for common shares, and they would be fully voting and fully participating common shares. If they default, there's a few different possible consequences. Funds paid to date could be refunded, so we would just undo the transactions that we've recorded before. So the funds paid to date would be refunded with the deduction for fees, costs of transaction costs, and the balance of the contract would be cancelled. There would be no new shares issued. Or you could have a case where the funds paid to date are forfeited, transferring it to the contributed surplus account, which basically means that what they've paid already gets given to the other shareholders, and there's no refund or shares being issued, and the contract is cancelled. Or it could be possible that shares are issued for the amount paid with the balance of the contract cancelled. So if you paid 50%, you get 50% of your subscription number of shares. If you default after the first payment and the funds are refunded with no penalty, the accounting would be like this. We'd debit common shares subscribed to reduce them. We would credit accounts payable or cash because we owe them the money now, and the subscription receivable would also be reduced. So basically undoing the first transaction that we set up. If we default after the first payment and the shares are issued for the amount paid, we would reduce the common shares subscribed because they're no longer relevant. The share capital would go up to the $5,000 that was already paid, and we'd reduce the subscription receivable because they didn't owe us any more money. The contract would be cancelled. If they defaulted after the first payment and the funds were held by the corporation, the common shares subscribed would be reduced to zero. The subscription receivable would be reduced to zero, and the net amount, the $5,000 that were already paid to us, would go into an account called contributed surplus, which would be part of share capital, and basically we'd be giving the money to the remaining shareholders. If shares are issued with other securities, this is the one we were talking about before. If shares are actually issued with other securities, we need to allocate the lump sum paid to purchase them somehow between the securities. So there's two methods: the proportional method, the relative fair value method, or the incremental or residual method. In which case we're basically assessing them to determine what market values are most reasonable, most well supported. If the value of the securities is equally valid, equally objective, we would use the proportional method to allocate the costs, allocate the lump sum purchase price between the two securities. The incremental method would say which of the two classes of shares is most objective, most reasonable, and that the allocation would be first to that one, and then anything that's left over would go to the other securities. Share issue costs. Share issue costs include legal fees, accounting fees, other fees and commissions, mailing, printing costs, taxes, anything that is associated with the cost of actually issuing shares. Now, these amounts are not a business transaction because they're a transaction between the owners of the corporation and the corporation rather than their customers or suppliers. So they are considered to be capital transactions, and so we wouldn't include them in net income. The accounting treatment, we'd debit them to share capital. So they're part of the cost of the share capital account. So if we issued $10,000 worth of shares, and so we sold 1,000 shares for $10 each. If there was $500 in issue costs, the $500 would reduce the amount of cash we actually received, and so that reduction would be reduced to share capital. Only the net proceeds would be included in share capital. Reacquisition and retirement of shares. There are a number of reasons why this might happen. They may reacquire their shares to increase the earnings per share to the degree that that's done for the benefit of management to make them look better. That's not necessarily good accounting disclosure. They may want to have enough shares on hand to meet employee share compensation contracts without issuing new shares to do that. So if they have employee stock options outstanding, they may want to establish treasury shares to make those payments. That avoids diluting the interest of the existing shareholders. They might want to buy out a particular ownership interest because that either they don't agree with them anymore, they're having arguments, or often happens in the case of a closely held corporation where one significant principal or founder of the company has passed away, and members of the family don't want to participate in the management of the firm. They buy out the particular ownership interest so that the family can have the proceeds from their family members' participation in the establishment of the firm, and then the other owners will continue to operate the firm thereafter. If they want to prepare for a potential merger, they may have some people who want to participate in the merger and some people who don't, so they may pay out the ones who don't want to participate. So there's a number of reasons why firms could reacquire their shares. If they buy back particular classes of shares, they may have an impact on takeover attempts. So if there are some members of the organization who are thinking that they might want to participate in the takeover, but the management doesn't want to actually sell the firm to the corporate raider in question, they may buy back the shares from the owners that want to participate in the share offering. So they may actually offer a premium to buy back those shares so that they're not available for the takeover attempt to use. If they want to reduce the number of shareholders, or if they want to be able to issue new shares, so they want to actually participate in marketing them, or if they just want to return cash to shareholders. There's also a signaling effect. So if you're buying back shares, you're basically signaling to the market as managers who make this decision. You're signaling that you think that the shares are underpriced, and so you're buying them back at a bargain, which makes your shareholders, your remaining shareholders, better off. So there are a number of good reasons to do that, but we're mostly interested in the accounting for this here. So it's possible that the shares might be retired when they're reacquired, so they may be actually taken out of authorized and issued status. They may also become treasury stock, and treasury stock means that we're holding them to reissue them. So the employee stock option justification that we just read about would require treasury stock to be held for reissue later. They may be retired, they may be held as treasury stock. Appendix 15A talks about treasury stock and the accounting for it, so take a look at that if you're interested. In Canada, the Canada Business Corporation Act requires that purchased shares be cancelled and restored to status of authorized but unissued if a limit to authorized shares exists. So uh, in the case where there's a limit on the number of authorized shares, they have to actually be cancelled, and then they have to be reissued later uh, with essentially new shares in that case. So accounting for it, share capital is debited with the original issue value, so we remove what was actually allocated to them, and then we have to account for the amount of equity in two other kinds of accounts: the contributed surplus and retained earnings. There's a number of ways the contributed surplus comes up. One is if there's par value shares, but we've basically said we'll leave that to you to investigate. Contributed surplus can also result from transactions between the firm and the market. So if they're basically making money by buying back the shares, that gain gets included in contributed surplus. It's not an income gain; it's purely in the equity accounts. And of course, retained earnings. Each share has exactly the same right to participate in the contributed surplus and in the retained earnings. So when you retire shares, you need to get rid of their share of contributed surplus and their share of retained earnings as well. So you need to account for both of those. So let's imagine the situation where Cook Corporation purchased and canceled 500 Class A shares at $4 each. There were 10,500 shares issued and outstanding, and total share capital is $63,000. That's the original amount for the shares that were. Well, that's the dollar amount that's associated with all of the shares that were outstanding. So we would debit common shares. The share capital account would go down by 500 shares times 63,000 over 10,500. So a proportionate reduction in common shares of $3,000. We would get cash of $2,000, and that whatever the difference would be contributed surplus. So we're paying $2,000 to get rid of $3,000 of share capital carrying value on the books. The gain or loss goes to the account called contributed surplus. All right. So there's two different kinds of dividends, two different classes of dividends: a return on capital and a return of capital. A return on capital is allowed, and that's our standard dividend, which actually provides a return to the investors who have given us the money, or whoever they've sold it to on the secondary market. So that's actually return on your invested capital. A return of capital is also known as a liquidating dividend, because you're actually selling off part of your company. Important dates for dividends are the date of declaration. That's when they become a legal liability. The date of record is the date that we're going to use to identify who gets the dividend, so that establishes whose right it is to receive the dividend. And then the actual date of payment. And when you actually pay the dividend, the value of the share goes down because the dividend has been paid out. So the accounting for, here we're talking about cash dividends. The accounting for a cash dividend requires information about those three key dates. And on the date of record, the date of declaration, you would set up the liability at that point, so you have to do accounting for that. There wouldn't be any accounting entry for on the date of record, because it just establishes who's going to receive the dividends. And then on the date of payment, you actually reduce the cash and record the dividend as being paid. So you could set up a dividend payable on the date of declaration. Nothing happens on the date of record, and then reduce the dividend payable when you've actually made the payment. So the first journal entry on the date of declaration, we debit dividends. Some firms just take it directly out of retained earnings, so debit directly to retained earnings. It would be the only debit on the list, so not hard to identify the dividends as a debit to retained earnings. And we would set up the dividends payable. On the date of payment, the liability is actually reduced by the payment of cash. So dividends payable gets debited and cash gets credited. So on the date of record, we prepare a current list of the shareholders. And so in order to do that, we take a look at the registered owner of the shares. And then we pay out the at the end of that day, we would take the record and whoever is on the record at the end of that day. We wouldn't do it intraday because then the shareholder list would actually be changing. If we use a dividends account rather than the retained earnings at the date of declaration, then we would have to do a closing entry at the end of the year, which we've addressed in 253 a long time ago. Dividends in kind. Property dividends, or dividends in kind, represent a distribution of corporate assets other than cash, and so you're actually paying out a property, and so it can be viewed as a non-reciprocal transfer of non-monetary assets. And this is covered in the CPA handbook under Part 2 and in ASPE in Section 3831. So such transfers would be recorded at the fair value of the assets transferred. And fair value is measured by the amount that would be realized in an outright sale at the time of distribution. So when a property dividend is declared, fair value should be recognized in the accounts with the appropriate gain or loss recorded, and then the fair value serves as the basis used in accounting for the property dividend. So if a corporation held shares of another company that it intended to distribute to its shareholders as a property dividend, it would first be required to make sure the carrying amount reflected current market value. Then if on the date the dividend was declared, the difference between the cost and fair value of the shares to be distributed is other than zero, so there's a value increase or gain or loss on those shares. That following you'd have to make an entry to adjust the value of the investment in securities and record the gain or loss at that time to adjust the fair value on the books of the corporation before you actually distributed them as a dividend. Number of ways you can determine fair value as listed here. You can use similar assets. If there is a liquid market, you could use the quoted market prices, or you could actually have them independently appraised by someone who does that as a business. A stock dividend. A stock dividend doesn't require the issue of any additional assets. A stock dividend occurs when the board of directors declares that a dividend will be paid to shareholders in the form of the company's own shares. They could be the same or a different class of shares. Accounting for a stock dividend results in a capitalization of retained earnings. So it transfers the retained earnings from the retained earnings account into a share capital account. So as such, as total shareholders' equity remains unchanged when a stock dividend is distributed, but all shareholders retain their same proportionate share of ownership in the corporation. They just have a larger number of shares. The CPA Canada Handbook makes no recommendations regarding the amount of retained earnings that should be capitalized when a stock dividend is declared. So the CBCA states that the declared amount of a dividend stated as an amount of money shall be added to the stated capital account maintained or to be maintained for the shares of the class or series issued in payment of the dividend. That's section 41.2 of the CBCA. It does not allow shares to be issued until they're fully paid for in an amount not less than the fair equivalent of money that the corporation would have received if the shares had been issued for cash. So therefore, the market value must be used for companies incorporated under the CBCA. And throughout the text, the amount to be capitalized is the fair value of the shares issued. So stock dividend, no assets distributed, unlike with cash dividends or dividends in kind. Total shareholders' equity does not change to just a rearrangement of money or value from the retained earnings to the share capital account. It's measured at the fair value of the shares at the declaration date, so the date that the liability is created. Each shareholder has the same proportionate interest in the corporation, but book value per share decreases. Book value per share decreases. Not sure that it does. Oh, well, I suppose it does because there are more shares issued now. So yeah, okay, so the book value per share decreases because you're dividing the same book value, which hasn't changed, dividing that by more shares. So I guess that does make sense. Stock dividend example. We've got 1,000 common shares outstanding. Retained earnings is 50,000, so 5,000 per, or $5 per common share. We issue a 10% stock dividend. We declare a stock dividend of 10%. So the fair market value is $130 per share. So the $130,000 in total. 10% of that is 13,000. We record dividends of 13,000. We record an increase in common shares of 13,000. So we're transferring money out of the retained earnings account into the common share account. Liquidating dividends. Liquidating dividends represent a return of the shareholders investment rather than a distribution of profits on the shareholders' investment. So in a more general sense, any dividend that's not based on profits must be a reduction of corporate capital, and to that extent, it's defined as a liquidating dividend. So it's a return of the shareholders' investment, not a return on the shareholders' investment. Preferred share preferences. The amount of dividends that's available for distribution to common shareholders is dependent on the terms of the preferred shares. So that amount can vary depending on whether the preferred shares are cumulative, participating, and whether there are any preferred dividends in arrears. So cumulative shares, any dividends that are not paid in the past would be added to the preferred shares dividends in arrears amount. If it's participating, that means that preferred shares are participating in income, so they're entitled to dividends along with common share after a certain proportion has been paid out to the common share holders. So there are some numerical examples in the text that talks about these features in various combinations, showing their impact on dividend distributions when both common and preferred shares are involved. So we have an example here. $50,000 is the total declared as dividends. Common share capital is $400,000. We've got $1,006 preferred shares. So that means that each preferred share is allowed a $6 dividend before the common shareholders can receive anything. So the preferred share dividends have been paid for the past 2 years, so there are none in arrears. And we want to calculate the dividend distribution to common and preferred shareholders based on the different kinds of dividend preferences. So if the shares are non-cumulative and non-participating, then the dividends are distributed only when declared up to the stated amount of the share. So you get $6 and then you don't get any more if you're a preferred shareholder. No amount is paid for years and when dividends are not declared because they're non-cumulative. If they miss it this year, you don't ever get it, which will affect the value that you are willing to pay for one of these preferred shares. So the dividend distribution in that case would be the preferred shareholders get $6,000, $6 each times 1,000, and the common shareholders get the rest. Potentially they could get the other $44,000 of the $50,000 income. If the preferred shares are cumulative, and let's imagine that they weren't paid to preferred shareholders in the previous 2 years, then those dividends in arrears would have to be paid as well as this year's dividend before the common shareholders got anything. So the preferred shareholders in this case would have $18,000 paid to them, $6 per share times 1,000 shares times 2 years of dividends in arrears, plus $6,000 for this year. They get their $18,000 first. The common shareholders get the remainder, the $32,000 residual that's left over. So if the preferred shares are non-cumulative and fully participating, using the same data that we had before, we use the relative value of the shares to determine their entitlement to participate in income above the entitlements for dividends. So the current year's preferred dividend is $6,000, and the current year common dividend is at the same rate, 6% of the $400,000 of value. So the $400,000 is stated as common share capital, the original contribution of the investors in common share investments. So 6% of 400,000 participating at the same rate as the preferred. So $6 on $1,000 is a 6% dividend payment. So the preferred shares get $6,000 and the $24,000 goes to common, and then they share on a prorated basis for the rest. So the remaining $20,000 of income, we've got $66,000 plus $24,000 is $30,000 of dividends paid out of our $50,000 of income. So there's $20,000 left to be allocated between the two. They allocated on the basis of $20,000 to $500,000, so a 4% rate. Why 4% rate? Because there's so the 4% represents the fact that there's $20,000 and it's going to be allocated on the basis of the contributed capital. $500,000 is $400,000 for the common shares and $100,000 for the preferred shares. Quickly scan back here. There we go. Common share capital is $400,000. Preferred shares, $100,000. So that's the proportion to which they participate in income above the equal distribution of dividends represented in the 6% preferred share dividend amount. So in this case, there are 4% times 100,000, 4,000 of the dividends go to the preferred, 4% times 400,000, 16,000 goes to the common shareholders. And then all of the 50,000 is paid out. Stock splits. Stock splits result in an increase or decrease if it's a reverse split. So you could actually have a reverse stock split, which reduces the number of shares. A stock split results in an increase in the number of shares outstanding, but no accounting entry is required for a stock split because it's only the total dollar amount of the equity accounts remains unchanged. But a stock split is basically designed to just increase the number of shares. So basically divides the shares into smaller pieces, so it makes it easier for investors to purchase it. So it's not actually recognition of, we're not capitalizing part of the earnings as we were in a stock dividend. We're just acknowledging the fact that our shares are a bit too expensive, so we want to reduce the value per share so that investors can more easily invest in our company. So stock dividend is a dividend, so we follow dividend accounting rules. We actually reduce the retained earnings, and then we put the rest in we put the opposite side of the journal entry into the share capital. Both the number of shares and the amount of share capital change. There are no new shares being exchanged, but everybody has the right to a larger number of shares. A stock split just increases the number of shares. There's no effect on share capital. So a stock split is usually intended to improve the marketability of the shares by reducing the market price of the stock being split. So in general, the difference between a stock split and a stock dividend is based on the size of the distribution. They don't actually say this is a stock dividend, this is a stock split. But if the number of shares issued in a share dividend exceeds 20 or 25% of the shares outstanding, it shouldn't be called a share dividend, but a share split, or a change in the number of shares only. Only the par value of the shares issued is transferred from the retained earnings in that case, if there is a par value. A stock split is distinguished by a stock dividend because a stock split results in an increase in the number of shares with no change in share capital or retained earnings. On the other hand, a stock dividend may result in an increase in both the number of shares and in the share capital while reducing the retained earnings. Stock dividend of less than 20 to 25% of the number of shares previously outstanding is generally accounted for at the fair value of the shares. So a stock dividend of more than 20 to 25% of the number of shares previously outstanding is generally accounted for at par or the original cost of the shares or fair value. All right, the components of shareholders' equity. Contributed surplus is one that we haven't spent a lot of time on here, but the components of shareholders' equity, the share capital can be either common or preferred share capital. Those are the original contribution. Contributed surplus, if there are par value shares, then the contributed surplus would be the excess over par. So it would be treated as a separate account, but it would be part of contributed capital. Contributed surplus can also arise, as we've seen earlier, if there's a gain on subscriptions or a gain on repurchase of shares. That amount would go into a contributed surplus positive account. If there is contributed surplus and we repurchase shares at a loss, the loss would reduce the amount of contributed surplus. Retained earnings. Retained earnings and accumulated other comprehensive income are both part of earned capital, and so they're different from contributed capital. Contributed capital is actually the amount of the investment in the firm. Retained earnings and other comprehensive income, accumulated other comprehensive income, would have been earned in the company since it began operations. It's a retained portion of earnings from the past. Kinds of transactions that could arise in contributed surplus. One is par value shares, retirement of shares, treasury share transactions, liquidating dividends, change the amount of contributed surplus, financial reorganizations, which are discussed in Appendix 15B, Stock options and warrants can result in contributed surplus, which we're going to talk about in Chapter 16, the next chapter. An issue of convertible debt can affect the contributed surplus. Any forfeited share subscriptions, like we've seen earlier, donated assets by the shareholder will go into contributed surplus as opposed to share capital. It's shared among all the shareholders equally. Redemption or conversion of shares can affect contributed surplus as well. Accumulated other comprehensive income is the result of the treatment of revenues, expenses, gains, and losses that result from non-shareholder transactions. So they're part of total income, but they're not included in the calculation of net income. So essentially, we're talking about paper gains and losses. It would include changes in the value of unsold, market value of financial instruments, shares in other companies, those sorts of things. Operating in foreign locations, sort of foreign currency translation issues can result in other comprehensive income. So there's a number of categories where you would actually see other comprehensive income arise. And essentially it's unrealized or gains or losses which are not exchanged for cash. Okay, there's a list of things that can contribute to contributed surplus transactions, which I just discussed. Par value, share issues or retirement. So in the case of par value, the contributed surplus is everything above the par value, and so on. So treasury share transactions, if you're buying back shares at a gain, it would go into contributed surplus. If you're buying them back at a loss, that would reduce the amount of contributed surplus. Liquidating dividends are payments, returns of capital, and so that would reduce the contributed surplus proportionately to the amount of liquidating dividends that are paid out. Financial reorganizations, Appendix 15B, stock options, warrants, convertible debt, Chapter 16, share subscriptions forfeited, covered earlier in the PowerPoints, donated assets by a shareholder, and redemption or conversion of shares. Retained earnings, effect on retained earnings. So this is kind of the retained earnings T account. On the debit side, a net loss during the year would be a debit. Accounting principal changes, if you have to account retroactively for accounting principal changes, and those accounts result in additional expenses that you hadn't recognized before, that would be a debit to retained earnings. As you can see, it also includes, on the credit side, accounting principal changes, which result in increases in revenue or reduction in expenses. Cash, property, and stock dividends reduce retained earnings. Adjustments from financial reorganization would be a credit because you're doing that for the purpose of recognizing the value, the fair value of the assets. And some treasury share transactions reduce retained earnings because the treasury shares basically capitalize the retained earnings in a way similar to the share dividends, which we talked about. Accumulated other comprehensive income. Non-shareholder transactions, so it's actually between the company and other external parties. It's not between the company and its owners. It's excluded from net income. It's considered to be earned income but not actually realized yet. So the concept of comprehensive income doesn't apply for ASPE, it's only IFRS, and we've dealt with this throughout 353 and 354 to a lesser extent. Basic disclosure for share capital. So basic disclosure is required. You need to tell the readers what is authorized in terms of share capital, what is actually issued in terms of share capital, and any changes in share capital since the last statement of balance sheet date, essentially the last statement of financial position date. Additional disclosures, the authorized number of shares. If there's no limit, you have to say that. The existence of any unique rights, such as dividend preferences, so preferred shares need to be shown separately from common shares. The number of shares issued and the amounts received for those shares, whether or not there's a par value or no par value for the shares, the amounts of dividends in arrears for cumulative preferred shares, any changes, details of changes during the year, and this would be presented in the statement of changes in equity under International Financial Reporting Standards. Any restrictions on retained earnings, so if the board of directors actually allocates a portion of retained earnings for a particular purpose, those restrictions would have to be designated as such. And any shares reserved for future use, including any terms or amounts attached to them. For example, treasury shares that are being held for the payment of employee stock option plans in the future. Under IFRS, firms must also disclose information about objectives, policies, and processes for managing capital, if there are any. Relevant analysis of shareholders' equity. The rate of return on common shareholders' equity, so return on equity, if you take the net income minus preferred dividends, because that their participation happens first. So take net income minus preferred dividends. We don't have to take out interest because interest is already taken out in the computation of net income. So net income minus preferred dividends over average common shareholders' equity. And so when we use the term average common shareholders' equity, we would use the beginning and the closing balance sheet numbers to calculate the average. So as with any ratio that compares income versus balance sheet, we use the average for the balance sheet because we're getting a little bit more information involved in the calculation. The dividend payout ratio takes the cash dividends paid to common shareholders and divides that by the net income available to common shareholders, so net income minus preferred shares. Dividends. Price earnings ratio, the market price per share and earnings per share. Earnings per share we talked about in 353. It's basically the earnings divided by the number of shares, weighted average of shares over the year. The market price per share is the price at the end of the period for each share on presumably a liquid traded market. Book value per share is the shareholders' equity, the entire common shareholders' equity. So we would remove the preferred share from equity. Just the common shareholders' equity divided by the number of shares, outstanding shares. That's the book value per share. So the book value per share is the amount each share would receive if the company was liquidated on the basis of the amounts reported on the balance sheet. So that would be calculated as common shareholders' equity divided by the number of outstanding common shares. Looking ahead, there are a few projects being undertaken by the International Accounting Standards Board and the U.S. Financial Accounting Standards Board. They're looking at the presentation of financial statement, a project called the Presentation of Financial Statements Project, or the Performance Reporting Project. A few things being considered there. The Disclosure Initiative is a project that they're undertaking right now, and another project entitled Financial Instruments with Characteristics of Equity. So trying to distinguish what exactly is debt, what exactly is equity. The Presentation of Financial Statements Project is closely related to the Disclosure Initiative, so the International Accounting Standards Board is waiting to see how this project unfolds before deciding how to move forward with the Presentation of Financial Statements Project. Discussions have also begun again on the Financial Instruments with Characteristics of Equity project, basically debt versus equity, and the IASB, the International Accounting Standards Board, plans to issue a discussion paper at the time of these PowerPoints. No dates have been announced for any of that yet. And that's it for Chapter 15.